Thank you very much, Mr. Chairman, Mr. Cohen, members of the committee. I have 3 points today. I will disclose up front. The third point has subpoints, so before you criticize my math. The first point is this. The regulatory system in this country makes us a stronger nation. It makes us healthier, makes our economy more secure, makes us fairer, makes our environment cleaner. It's a point that I think is lost in much of the regulatory policy debate and focuses on cost. Indeed, there's no small irony in the proponents of cost-benefit analysis when it comes to regulation, talking about regulatory policy but focusing exclusively on cost and ignoring altogether the benefits of the fair kind of analysis they suggest should be done. For example, if you look at the American Action Forum analysis on costs, costs are fairly calculated. The cost of 2012 regulations are on the order of $220 billion. The primary cost in that figure is $150 billion attributed to fuel efficiency standards, the CAFE standards that will take effect in 2017. Also, we're just relying on EPA analysis. The neglect, however, mentioned the benefits. The benefits are far greater than the costs. These are not abstract benefits. They're not based on health impacts. They're primarily based just on savings of the gas pump. So, in the year model year 25, consumers will pay $1,800 additional for automobile, but they will save between $5,700 and $7,400 per automobile. In fact, if you look at the CAFE standards that started in 2012 and the new ones that will come into place in 2017, the overall net benefit to the United States is $1.7 trillion, trillion with T. That is indeed one of the most efficient regulations we could imagine. It will massively increase huge benefits for small business and massively increase global competitiveness for American business. Second point, too much of the debate about regulation, jobs, and the economy ignores the cause of our current jobs crisis. The housing bubble, that financial bubble, financial crash, Great Recession, ongoing stagnation, are traceable in very large measure to regulatory failure. It is indeed, as Mr. Rice said, in part a failure of regulatory enforcement. It is also a result of the rollback of previous existing regulation and the failure to adopt additional regulation to deal with ongoing issues. So, for example, there was insufficient regulation on toxic and predatory mortgage lending. There was too little regulation on securitization, too little regulation and inadequate enforcement on credit rating agencies, too little regulation, actually no regulation on financial derivatives that expanded the crisis, insufficient capital standards required of financial institutions, and so on. Many other examples listed in my testimony. It's worth underscoring the impact of the Great Recession, $13 trillion in reduced economic output, $9 trillion in lost home equity, that partly is inflated by the actual housing bubble itself. Third point, to say the regulatory system provides so many protections for our country is not to say that all is well. There are indeed many problems with the regulatory system that needs very far-reaching repairs. We've got a number of examples elaborated in my testimony. I wanted to highlight just a few. First, we can put the chart here. The regulatory system now is characterized by a Rube Goldberg process that actually builds in endless delay. This chart follows that Rube Goldberg process, although it's unreadable unless we blow it up to a screen about 6 times bigger than that one. I think the lesson from that is not that new additional analytic requirements should be imposed on agencies, but that we ought to try to streamline the process to the extent we can. But new analytic requirements of the kind embodied in the Regulatory Accountability Act, I think, are the wrong way to go. A second point, which is also implicit in that chart, the OIRA is a roadblock to effective new rulemaking. And there needs to be not an expansion of the scope of OIRA authority, as we required under several so-called regulatory reforms. But he's increased transparency at OIRA and increased accountability at the agency. Indeed, I think as regards the independent agencies, those are accountable to Congress, not to the executive, and it would be a mistake to expand the executive's direct authority over them. Third point, there are issues about regulatory enforcement and rulemaking and undue influence of regulated parties and regulated agencies. That's a hard problem to deal with, but one important thing we could do is to crack down on revolving door abuses, which continue despite some reforms by the Obama administration. And the last one, the matter of small business. There is an important discussion to be had about the nexus between regulatory policy and small business interests. But one thing I think that's been too overlooked is how competition policy is needed to advance small business interests. I go into some detail about this in my testimony, but one area that perhaps there can be bipartisan agreement about would start by looking at the too big to fail financial institutions that get an implicit subsidy of about $80 billion according to Bloomberg. And I think that is a complete unfair situation as regards small banks and it disadvantages other businesses as well. Maybe that's an area where there actually could be some regulatory policy going forward across party lines to advance small business interests. Thank you so much. Well, since the audience here, I have a couple words with that, but I did review again the dissent that you co-authored to the Financial Crisis Commission report. And it is indeed a thoughtful perspective one, trying to explain the crisis. My interpretation, though, is it's not fundamentally one that's at odds necessarily with the majority, but in any case, with a view that says that regulatory failure was a considerable contributing factor. The framework explanation and dissent that there was a housing bubble and a financial bubble, those are sort of structural factors. And you look at this cross-cultural comparison, they may not be attributed to any regulatory assurance that's domestic, but that they were exacerbated, that those problems were exacerbated by a number of things. Bad mortgages, relatively unregulated securitization, financial derivatives and derivatives trading, and credit ratings failures, all things that were listed in dissent. From my point of view, those are all things that either should have been prevented altogether or problems should have been limited through appropriate regulation, either better enforcement or stronger rules and books. I think the key issue that's highlighted is what happens when there's a new technology or an old technology that's operating at a scale beyond anything that happened before. And I think there's a key role for Congress to say, look, we need a framework to think about this. The frustration of, I think, these agencies just trying to catch up, they're behind. I think there's a huge number of things. I think the first point is that much of regulation is being criticized actually itself as a spur to new innovation. So if we talk, for example, about the fuel efficiency standard, that's going to spur all kinds of new innovation in the auto industry. The various environment or energy efficiency standards that are being promulgated by the EPA will massively spur innovation. So if you look at the auto industry, the same kind of things. In fact, we're looking at the airbag example. I mentioned this in my testimony. When airbags were first being proposed, seriously considered, in the 1970s, the industry said the cost, publicly they said the cost was going to be well over $1,000, sometimes up to $1,500 or more. Internal data showed that the cost would be more like $200, and thanks to economies of scale, dynamic efficiencies, actually costs are now far, far lower, and we're saving $2,300 a year. So actually a lot of regulation is itself innovation spurring. If you want to look, I think, broadly in terms of making the economy more stable in the regulatory area, I think, given the experience we just had with the Great Recession, the most important thing is to stabilize the financial system. I think there probably is pretty widespread agreement that the system remains quite fragile. From my point of view, if there's a single most important thing to do, really is to go after the large institutions that are able to hold hostage prosecutors, enforcement agencies, and some extent Congress. I don't think there's any solution to that short of breaking